G'day and welcome to the Investor Motivation Podcast. My name is Rob Gowding and join me today, who have I got?
Amy Lehman.
G'day Amy again, as always. Welcome back.
Thank you. How have you been?
Going well. It's been a great week. Love chatting with people from all over Australia. It's been really nice.
Yeah.
So thank you for those that are listening to our podcast. It's actually great to get to know some of the people that are listening to us and getting value out of what we do. So after 12 and a half years of doing videos and YouTubing and education, it's great to be able to talk to some of the people at the other end.
Yeah, and if you're someone that has been listening to us for a while and just umming and ahhing about whether having any financial advice or a meeting with us is appropriate, just book it in.
Book it in. Doesn't cost anything to have a conversation to see if we can help. And so today, what are we having a conversation about?
Today mainly you will be steering this one because we will be learning from past failures. You have been in the game a lot longer than I have, so you will be able to speak to these a lot better, but we'll also identify what specifically went wrong with some of these businesses and how people might be able to spot these red flags moving forward.
Now, we're not talking about scams, which is prevalent at the moment. We could do a whole another session on where cybersecurity and scams are up to. So we're not covering off on that. We're covering off on failed investments, failed business models, things like that. That I've seen in my time, and thankfully, when I look through the list, I've actually avoided the six that we've got here, and some of these are one strategies, and some of these are products that I could have invested my clients into or my own money into along the journey. So to date, I've avoided those, and I've always said to clients, it's not just about what we recommend you invest into, it's also the stuff that we don't talk about, the stuff we avoid. And that's probably unspoken about, not only as to where to invest, but where not to invest and why.
I've definitely sat in on some appointments with you where clients have had these in the past, and it's made them wary moving forward and quite questionable with us about how exactly their money will be invested in what structures. So it's really a good idea to cover off on this and hopefully set people at ease on the way our business works.
Yeah, and each one of these investments, obviously forms the way the advice is given, and sometimes for some clients I can be quite negative on some of the things they currently have, where they might have first mortgages and so I'm going to get 8.25% return, but they're not understanding where that money's been lent to, who it's been lent to, and what rate, and which may have knocked them back for them to go to a secondary or third lender, which just increases the risk substantially. So these are the things that we've learned from, and for me that's 26 and a half years worth of giving advice and seeing failures and learning from those. And if my memory stands up, will be good. I'll convey the stories to Amy, so Amy will remember. Because
second-hand learnings.
Yeah, because investors become forgetful. There are big events that happen that make them really shy, and then all of a sudden, we have big crashes because stock markets around the world go far beyond what is reasonable in terms of a share price. People get greedy, and then it crashes again because they've overbought it and got too greedy. Investors forget. It's a psychological game, of course. But before we kick off, Amy, if you've got the...
On behalf of the Investor Motivation Podcast, we'd like to pay our respects to the traditional owners of the land on which we're recording and pay our respects to elders past, present and emerging.
Cool. The first one, in terms of collapses, is Storm Financial. I believe it was Toowoomba, Queensland.
Based in Toowoomba?
Yes, does that sound right? I'm not sure what reading you've done from there, but essentially what... So I think what we'll do, just so we set the scene for ourselves, Amy, is that we'll go through a the explaining what happened, and then we'll talk about perhaps the red flags and where it went wrong while we're discussing that one as well.
Perfect.
So Storm Financial was a financial planning firm. So
that's not the red flag, everybody.
Well,
that's not it yet.
It depends what the financial planning firm is doing, and the red flag is around obviously the strategy that they used, which was, and I remember it at the time, and this is around the GFC. All things come unstuck when markets become unstuck. when it hits the fan.
Yeah.
So what Storm Financial was doing was essentially a one strategy fits all. So it's the same strategy for everyone,
Yeah.
regardless of their objectives. And what they would do is, if you had some equity in your home, they would draw that equity out of your home, which means you're borrowing more money.
Yeah.
They would invest that into some product. I don't know what ETF or managed fund or product they use. That's neither here nor there.
Mm-hmm.
So they would invest that into the share market, because share markets are always good over the long term, which they are. But then they would take that product so money from your home is borrowed into a product, say it's 100 grand, and then they set up a margin loan and invest possibly a conservative 50% lend, and they would borrow again.
So you've doubled down.
Double gearing.
Yeah.
And what happened was that then we had the global financial crisis, and the market got spanked.
Yeah.
Because it was overbought, people got greedy, and then obviously these unknown events, the majority of people don't see coming. There was movies made on the groups that saw it coming, but there's very few of them.
Yeah.
I think it's The Big Short, is it?
Yeah.
Yeah. So obviously, a country financial plan, or any financial planning firm, any stockbroking firm, most people don't see this stuff coming. And the market went down, and people actually, they had, because there was margin lending,
Yep.
there was margin calls, they didn't have the cash to put in, which meant the investments were sold down, and these people went into negative equity on their home.
Yeah, right. So if they pulled 100,000 off the home loan, bought shares with that 100,000, and then took out a margin loan on that share portfolio of 100,000
Yep.
for more, 70,000.
Yep. So debt on debt.
Debt on debt. Markets do what they do, correct themselves, crash. When markets or shares fall, generally that margin call happens, where you have to repay some of that margin loan that you've taken out.
If you haven't got that cash to prop up the loan.
Debt obviously reduces your cash flow. You've got two debts there to service.
So the
forced
bank,
sell position at a loss.
Yeah, the margin lender would have sold those positions down, and that's essentially what happened. And it was huge. People lost homes. It was a really tough one to go through. So let's go and have a look at
What went wrong.
What went wrong, and obviously
you didn't make that clear enough as we were talking.
Clearly, debt, over leverage,
yeah.
Now in Australia, people are encouraged to take on debt. People are encouraged to negatively gear and lose money on investments, and it's the debt that helps do that. And so when I'm chatting to people around debt, I'm, smart use of debt is fine.
Yes.
You got a business opportunity. Think about debt is fine if the cash flow allows it.
That's the key word, cash flow, isn't it?
Cash flow.
You've got enough income as well to prop up debts. Yeah.
So too much debt always has to be a concern. What was the next one, Amy, in terms of where it went wrong?
Well, as you said at the start, a one-size-fits-all approach being, I just can't even imagine if clients were to walk in our door with every single person has different goals and objectives and different ways they want to get there and different risk tolerances.
Yes.
And then to just cookie cutter everybody into one product and tell them to take out more debt to be at such a high risk, that's absurd.
Yeah.
Red flag.
Well, that's right. So, advice that needs to be personalised to the individuals, the couples.
Absolutely.
Very good. So that is Storm Financial. The next one was Prime, and Prime very much shaped a lot of the way that we do things here, in terms of the way we explain how we invest on our clients' behalf.
Yep.
So, Opes Prime was a stockbroking firm, and from what I saw at the time was essentially that they had their lending facility. So again, this is debt driven again.
Yeah.
So spoiler alert, debt is obviously the big part of the problem. And I remember the story, and it's only in recent times, and I've gone back and reread a little bit, that there was some pretty ordinary corporate behaviours, poor management, and
Opus Prime itself.
Yes, yeah. But I didn't know that at the time. But what would happen was, and I remember the story that a investor put up his 200 grand worth of BHP shares as collateral for his margin loan that he never used. So debt that he was going to draw down on to further invest, he didn't actually use it. But when the GFC hit and the markets crashed, the banking facility that Opes Prime had with ANZ and Merrill Lynch, that was out of shape. So his shares got sold, although he didn't physically draw down himself.
No.
So all of a sudden, in a way, they were using his assets as security collateral for loans.
A larger amount of loans than
That's
just
right.
his.
Yeah. So that meant that when other people got out of shape, not him, the other investors, the company itself, he had no choice. They sold down his assets, probably triggered capital gains to boot as well. So all these problems just rolled out of that. So that resulted in, portfolios being liquidated and people lost a lot of money. And it was probably only afterwards where I read that there was other, management issues that were substantially wrong.
Yep, and I guess that's what's formed the way we operate here as Consortium and how you've built the business so that when clients invest with us, it's actually in their direct name, not lumped together with any other client or any other investor.
That's right. We do have our public offer, where we use Net Wealth or Colonial First State. There is that side of the business, but if it's a self-managed super fund, joint, individually held company, trust,
Investment
whatever.
Portfolio,
I've always said that we can go broke. I can go broke personally. Your assets are in your entity, and they won't be touched. So no one sits between you and your assets. So that's where a big part of obviously, and it was probably only one that because I started investing in a more direct manner, early 2000s. As I saw that as this is how I would like it done for me. And it was probably only since Opes Prime that I thought, oh geez, this is clearly a good way to do it. Where you own the assets directly, you've got control of the tax, and if someone goes belly up, you've still got your assets.
Makes nearly too much sense.
So what went wrong? Lack of transparency and probably understanding of complex structures.
Those people probably didn't realise the risk that if somebody else went belly up, they could be turned belly up too. And
I would say it's probably pretty fair to say that the average person wouldn't be able to know at the time.
No. It probably is all of these failures that have happened that unfortunately have happened, but it's good because now people are sceptical and we get asked those questions and people are doing due diligence now.
So lack of transparency, obviously the understanding of the structures, but again, probably at the top of the pile is debt.
Again. And
So
you didn't invest with that debt either.
That's right. Now I felt sorry for that case study, which was a real case study. Number 3, Amy.
Number 3 is Dixon Advisory. So this is a more recent one and similar in the way that it's a financial advisory business that's...
Like us again.
Yes, like us again, that has gone belly up. And again, a bit of a one-size-fits-all approach.
They would... I always remember the ads in The Age. They would take out... it was a Melbourne business, but they would take out full-page ads in The Age. I thought, wow, that must be a very successful company. And... clearly for a long time they were a very successful company and really specialised in self-managed super funds. But what happened during the GFC, they saw an opportunity to go over to the US and buy up lots of different real estate assets. I think it was in Jersey, New York. So they went over there, so they put together a product, bought all these assets, and then they were selling it to their clients. In addition to that, I think they had a company that would provide maintenance and services to that trust that owned all these property assets to go and fix things up.
Keep it all in-house in a way.
It was all in-house, and so I think they were making some pretty big fees out of that one. 40% of cost rings a bell. But I think in addition to that, part of the funding that the real estate trust was using was another product that the investment advisors or brokers were recommending. So it turned out that there was a whole heap of, related party investments where there was conflicts and, they were pushing their own funds, essentially, products that they made money out of. And that was something that was dealt with during, I think, the Royal Commission and some of the changes in our industry, that if you've got a conflict of interest, they not only, in the past, they needed to be disclosed, but then the laws have changed. If you've got a conflict of interest, you have to avoid it.
Yeah. To this date, we still have to keep our conflict of interest register, but we also do disclose. And if it is one of those severe, like this sounds like it is, conflict of interest, you have to completely avoid and not provide advice, essentially.
That's right. So essentially what they were doing, if we said, right, how could we replicate this? Well, one, we can't. But if we
We wouldn't.
Legally we can't. But if we set up an investment trust and we were getting 1% fee on that trust, and then Amy and I, as financial advisors, just recommended that trust to our clients,
Yeah.
in addition to our own advice fees, that would be very similar. So obviously, what went wrong?
Conflicts of interest.
Yep.
Biased advice.
Yeah, it was biased advice. They were recommending in-house products, and obviously,
Receiving that double fee as well.
more than likely, and probably diversification. Obviously, I don't know what happened to the client's other money, but I heard that it was, quite often
Quite concentrated.
very concentrated into these funds.
Yeah.
Very good.
Yeah.
Now here's one. This is probably the oldest one of the book, and one that I do remember. But West Point Financial sounds impressive. So what these guys were doing, they were building apartments, townhouses. I said it's a long time ago. It's coming up 20 years, but they were raising money off financial planners, paying commissions of 10%. And they were taking that money.
So financial advisors were told to clients to invest in this thing, and the financial advisor got 10% commission.
Well, that's right. So, but they were promised a high rate of return.
Yeah.
That money was
They always are, aren't they?
Always
Promised.
are. That money was then lent on to, from one entity into West Point, so they could build properties to then sell.
Okay.
And it was unsustainable, and it all fell over.
Yeah. Well, that 10% commission, again, conflict of interest.
Well, that's right. It's just unreasonable. It doesn't pass the common sense rule at all. But it was high. No doubt there would have been debt within that as well. So they'd get the money. There would no doubt be debt in there as well. But it was high risk property investments. So West Point were offering unsecured notes to investors, promising high returns without underlying assets to back them up. That in a nutshell. So and this is where a lot of the first mortgage investments that people often still talk about now, that there's property, we've got a first mortgage, or it's a first mortgage fund where there's lots of properties and there's first mortgages over these properties. Things can go wrong.
Yeah, the reason that it's gone to this first mortgage place is because they haven't been able to secure finance through the bigger channels and regulated channels, more so like the banks.
Yeah, like the big four banks.
Do the due diligence and have been declined for a reason.
Correct. And the way I like to frame that to clients is that if banks are in the job of lending money, but before that they're in the job of assessing risk. So they will look at a investor's scenario, a person's scenario, and say, what are you using the money for? What is your balance sheet like? What is your income like? Yeah. And they say, nope, we don't like you. You do not get money from us. Then they go to these other lending options. And so if an investor is getting 8.25%, which I've heard of that number recently, that means
first mortgage.
Yes, first mortgage type. More of a pooled fund. It's not just one mortgage to one investor, but more of a pooled option that financial advisors recommend, and so they are out there still. Yeah. But you've got to say, okay, if I'm an investor getting 8.25%, that means that the company that is organising is getting their clip. You can add another 1 or 2% there, and then that means that the lender at the end is probably paying 10 or 11%, which means it's been knocked back at the banks.
Yeah, it's massive.
That's the way that I see it. I know it's a very simplistic way to look at it, but it makes sense to me.
Yeah, sometimes the most common sense way to approach these things is the right way.
Yeah, absolutely. So that was a really interesting one. It was a long time ago. There was 4,000 investors out of pocket, about 300 million on that one. Now, number 5 and number 6, which are our two last ones, and we'll cover off on a couple. Well, actually, we better just backtrack. There's one here that we had some exposure to. It was Banksia Securities. Now, we actually use Banksia Securities quite a lot within our self-managed super funds, and these were pooled first mortgages.
Okay.
But when the government's bank guarantee was put in place, I decided that, well, I get an extra 0.4% in Banksia under a first mortgage arrangement compared to a term deposit. I unwound it all.
Yeah.
Thankfully, before it went belly up. And most people dodged bullets there. I think Banksia had some really good rules around borrowing and who they borrowed to, that they got most of their money back, probably a bit over 90% from memory. It's a long time ago.
Yeah.
So they got most of their money back. But again, it was unsustainable.
And when you put it in that terms of there's a government guarantee, you can have up to $250,000 in a term deposit guaranteed return versus a first mortgage where there's no guaranteed return at all, but supposedly an extra 0.4%. There's absolutely no way that 0.4% is worth all that extra risk.
And that was the decision I made at the time. And it's all easy in hindsight to look back on this stuff.
That's right.
But it's just, so Banksia is sort of, in a way, not how they were taking that money and who they were borrowing to is very different to West Point. I'm not putting them together. But it was still ultimately property at the end of the day. Banksia were not as aggressive in terms of the rate that they would pay investors, and therefore means they weren't probably, they were more reasonable in terms of their lending.
Yeah.
But the last two we were keen to cover off, we're going to mesh them together beautifully. Now, we live in country Victoria. If we're in Horsham, we're about 2.25 hours away from the coast at Port Fairy. So if we drive from here through Hamilton, one thing that we got used to seeing over our lives was lots of blue gum plantations.
Yeah.
Lots of trees. So these, we're talking about Timber Corp. We're talking about Great Southern. Now, these guys collapsed in 2009, both of them. Storm was 2009. Opes Prime was 2008. So there's a fair bit of global financial crisis coincidences there. But what Timber Corp and Great Southern would do is they were buying tracts of land and they were planting blue gums.
Yeah.
And that was going to be for pulping and sent to China to turn into paper and other products, I assume.
So these are two direct businesses people would have bought?
Well, you could buy the I think were they traded? I believe they could have been.
Yeah.
Because I remember when an investor said, we avoided all of these, and an investor came and said, oh, Rob, I put X amount of money into some investment into some blue gum trees. The 10 years is now up. They should be ready. Said, great, you should get your money back. That was a bit of a
tongue-in-cheek.
And he goes, no, they've offered me shares in Timber Corp. And I go, that's not good.
Okay.
Yeah. So, and I just said, he go, well, what's happening? And I said, well, I just believe that if they're offering you shares in the business, it means they don't have the cash to pay you out.
Yeah.
Correct. They're illiquid. So what happened why these businesses got so big is people could invest $100,000 and get a full deduction for $100,000. The whole lot.
That was an approved government.
Mm-hmm.
Wow.
Yep. They wanted to, I suppose, bolster the sector. But once the trees were planted, there wasn't much to do. It wasn't great industry. It wasn't great industry. It wasn't going to employ thousands of people once the trees were in the ground. But I heard an interesting stat that out of every dollar that investor put in to claim their deduction, and also I don't know how correct this is, but it's stuff I read many years ago, that 50% of that money, 50 cents in every dollar, went to high commissions to financial advisors and accountants, marketing. And I remember an accountant mate of mine was flown from Victoria over to Perth to go and view Timbercorp's or Great Southern's amazing facilities / wining and dining.
Yeah.
So marketing, commissions, payments to others to get people to put money in for them to so few, small percentage, only half of the money got into the ground.
Yeah, to do the business that was supposed to happen.
Correct. Yep. So, and ultimately, the plantations, my son worked in some of these plantations as a koala spotter.
Yeah.
He got paid very well. And this was only in recent months, but so they are cutting them down now, but there are companies that have come in after everything's gone bust.
Yeah.
So what went wrong with Timbercorp and Great Southern, Amy?
Again, as soon as you hear the words commissions or people being flown anywhere for something, that's a huge conflict of interest.
Yeah. Obviously, I've always said this, putting tax before investment is always going to be wrong.
I do wonder if some of these people that did lose a lot of money on it, though, thought, I only lost, 60 cents on the dollar because 30 cents of that was a tax deduction anyway. I can just hear that.
Yeah, I hope they feel good. Hope they feel good about that. Obviously, the decision to invest was about tax, not investment. And an accountant told me many years ago that if it breathes or it grows, it's probably fair to stay away from an investment point of view. So we're talking about farming in general. But farming has been very good in recent times. I think clearly these are illiquid and long-term projects.
Very long-term. And after even 10 years, you still couldn't get the money out. And we do still see quite a lot of illiquid investments, especially in that property trust area where people are purchasing property trusts to this day.
Yeah.
And there's some that have that. I think we've covered off on this in a previous podcast, but if you only have a window once every 5 years to put in a offer to be purchased or sold out, that's a liquid, and that's a huge risk in itself.
Absolutely. One that I worked on with a client recently, you could get up to, they would liquidate 2.5% maximum of the fund in any 1 year.
Yeah.
Yep. So, and actually one of those ones actually stopped paying dividends altogether. So not only you can't get your money out if you wanted to, they stopped paying dividends. And there was another one that I was thinking about that really, where did that one go wrong?
Is this property trusts?
Yeah, it was in relation to. That's right. I was probably very fortunate that I had some experience with the trees because. Closer to the South Australian border, and sorry for the indecision there, it's just trying to get the brain going and the memory going, but so I avoided Timbercorp and Great Southern when it was all on everyone's recommended list. But I used to catch up with lots of clients in Nil and Coniva, and in the late 60s, early 70s, they were sold a lot of pine plantations over towards Mount Gambier. So I already had this experience where I said, how's that gone for you? Oh, we don't really know. We don't get anything. Or we get $20 a year on what was a $20,000 investment going back 30 years. So clearly been pretty bloody horrible. So I had that fortunate, experience where I learned what these experiences that other people had with pine plantations, which were sold in the late 60s into the 70s. So I had that bit of background to say, blue gums won't be for my clients. Regardless, I prefer people pay some tax. Minimise tax as best we can with the tools that we have that make common sense. Pay your dues and then invest. There's
much, much better ways, and we've covered them off on podcasts before, so go back and listen for those interested, but to reduce tax that doesn't compromise investment strategy or quality of investment.
Or just bucket loads of debt. To get deductions and depreciation. It's sometimes paying some tax is a good thing.
Absolutely.
Yeah, fantastic. Anything else, Amy?
No, I think that's probably all. I think if the red flags weren't clear in there, some of the common themes across all of those were conflicts of interest. If there's commissions being paid or something off about it, avoid.
Yeah.
Completely
Well,
avoid.
I think it's important to understand, and that's what I've challenged people a bit to do lately when, if you're, particularly in this property world where all, property spruikers, everyone property, there is only, the hammer is property, so everything is a nail. It is a one-size strategy to fit all. I think it's worthwhile just questioning everyone's motives.
Yeah.
Like, if property was amazing, I'd be there.
Yeah.
But it's not, and I'm not.
Yeah. And it's, well, we do say that about, it's avoid that cookie cutter approach as well and that one size fits all strategy, but it's probably also not comparing it to anything. If someone's going to recommend you do something, they need to, or you need to be able to think about what other options are out there and what their risk levels are.
Yes.
Like with that first mortgage stuff, a guaranteed, 8 or 9% return with a whole lot of risk, whereas the share markets on average produce 9-10% returns with much lower level of liquidity risk, especially. It's making sure you are comparing against other things and thinking about the opportunity cost there.
And obviously we had a chat with Peter Thornhill last week. That podcast will be out probably in the next few days. As Peter always said, where people say, oh yeah, I've done well, compared to what? So check out the podcast we did last week with Peter Thornhill, one of Australia's best investors.
Yeah, and that one's a really good one if you can watch that on YouTube as well, because he's quite animated and fun to watch as well as listen to.
Absolutely. Very good. Well, thank you, Amy. That was really good discussion, things that we can learn about from the past. It shapes the way we do things here, and it shapes the laws around financial advice as well.
And I'm very glad to hear a lot less of these happening, because the regulations have gotten so much tighter in the Royal Commission that when you tell me these stories, I go, what?
Yep.
How did that ever happen?
But I can guarantee you things like this will happen again.
Yeah, things will sneak through, won't they?
Fantastic. Thank you for listening in. If you'd like to learn more, we've got our YouTube channel, which is Investor Motivation. Check that out. There is coming up to 700 videos there. We've been doing it a while, over 12 years. Amy is on TikTok and Instagram, The Wealth Diaries.
Yep.
I'm on TikTok, Rob Gowdy, and on Instagram, and that's probably about it.
Yeah, and we're doing another podcast, aren't we?
Yeah, I think we will.
Yeah, so
Keep
we're
on
going to
rolling.
keep on doing, we're going to do a whole nother podcast theme. So we'll keep doing these podcasts that are more, strategy and discussion oriented. We're also going to introduce another style of podcast where we cover off on a share market business and cover off on a few key points that we look at when assessing businesses.
Yep.
One business at a time.
First off the cab is going to be Microsoft, one of my favourite businesses. I'll find it very easy to talk about, but we're going to look at 9 different important issues, such as balance sheet, earnings growth, all the things that we deem to be important, what we look for. So it's a real deep dive into a business, and we'll kick that off very soon. That'll be probably next week. The first one will be done. We'll be doing that on a weekly basis. So for those that are keen on investing like I am, that is my job and my hobby, tune in.
Yeah, and you'll hear a few of the other advisors in the office pop in as well. So you'll get a bit more variety than just us two all the time.
Awesome. Thanks. Cheers.
Bye.
See you next time.